So I checked the news this morning and oil prices reaching above $100. Conflicts are escalating, markets in the red, and a timeline full of people that are panicking. Okay, so what we're going to talk about in this video are three things. First up, what is actually happening? No drama, just pure data. Second, the three mistakes that investors are currently making that is generally costing them money. And third, a 5-point checklist that you can do right now to make sure that your portfolio is still on track. Now, I don't want you guys to wait till the end, so I'm going to give you a little preview of the 5-point checklist. I'm going to explain later on what each point exactly means, but here it is. So first up, we got your cash buffer. Second is reviewing your allocations. Third is your DCA automated. Fourth, do you have any risks in certain stocks right now? And then fifth, when did you last actually do an annual review of your portfolio? Now, I'm going to explain all those points later on, but first let's talk about what is actually going on right now. Okay, so what does the current and historical data actually show? Well, there's a geopolitical conflict escalating right now with oil prices reaching above $100 and Dutch benchmark gas prices like the Dutch TTF, they increased for 70% in a single month. Now, that's the strongest move since September 21, and that's real, and I'm not going to deny it. But it's natural that we feel that. I feel it too. When markets go down and news cycles, they go crazy, our emotions can take over. Now, it's important for us to think about it logically and not let our emotions guide our decisions. Because here's what's also true. Europe has been here before. It's nothing new. It's 2022. And Russia decides to invade Ukraine. Now, the energy price, they skyrocketed, markets, they crashed all the way down. And after a while, it recovered, it completely recovered, it came back. So the most important sentence for our long-term investors is simply that history repeats itself. Now, what does this mean for your portfolio as a European investor? Well, there are three things. Now, first up is your energy exposure, so the sector exposure. So let's say you are buying abroad UCIT like the VWCE, you probably have around 5 to 10% exposure to the energy sector. Now, oil prices skyrocket. This means that your portfolio actually increases because your prices go up. Now, this is a natural hedge that you didn't even think about. Now, second is inflation. Now, with the oil prices going up, your returns get lowered, your buying power is a little bit less because you have a lot more expenses. But if you're just dollar cost averaging for the next 15 to 30 years, this is just simply noise and you can completely ignore it if you stay true with dollar cost averaging. Now, third, and this one is specific to the Dutch viewers, which is box 3. Now, I've talked about box 3 before, but what essentially it means that we get taxed on fictional gains. This is calculated on the 1st of January, meaning anything that happens after that is not calculated. So this is one of those rare occasions that the box 3 can actually work in your favor. So now the key point of all this is that if you're invested in abroad UCIT or in maybe ETF, if you're American and watching this, if something like this happens and a single sector gets hit, it's nothing more than a single sector getting hit. It doesn't hit your plan, it hits a single sector. And that's important to remember. Okay, so what are the three mistakes that investors are making that I don't want you to make? Now, first up is selling, just going for cash. And I know it feels safe, the markets are going down and just want to cash out before it's too late. But selling is only half the decision. You still have to decide when to buy back in. And the data clearly shows that people always buy in back too late. They miss out on the recovery. and they're always worse off than if they just stayed invested. Now, second is over analyzing or analysis paralysis. They just refresh their app constantly, looking at the news, watching YouTube videos, and hey, don't get me wrong, thank you for being here. But if you just keep refreshing, keep watching the news, but don't act on it and don't trust your plan enough, it's not going to help. So trust your plan. If you have a good one, trust it and just stick with it. Now, the third and maybe the worst mistake of all is stopping your dollar cost averaging. Now, the thing is, when the markets are down, it's a sale. Stock prices are cheap. And these stock prices, these stocks that you buy right now in the dip, they are going to be your most effective stocks that you ever buy. Because the history repeats itself. The prices will go back up, and think about all the capital that you gained simply for free because you just bought stocks on sale. If you're going to fire in 15 years, these are the stocks that will compound the most. And this is the real magic. So please do not stop dollar cost averaging. Okay, so now let's talk about the 5-point checklist. First up is your cash buffer. Now what this means is that you should look to aim to have a buffer of 2 to 4 months of monthly expenses. That if anything happens, that you're not forced to sell off your stocks in order to pay your bills. I would aim between 2 to 5 months, but at least 2. Next up is your allocations. Now, depending on where you are in your FIRE journey, like if you have 90% equities and you have still 30 years to go, it's fine. But if you have 5 years left, it's worth maybe looking at it. But here's the key that you have to follow, that you change your allocations because of your plan, not because of any news cycle or world events that is happening. Third, your dollar cost averaging. Is it automated? If so, yes, please leave it, close the app, walk away, and that's it. If not, now during a dip, it's the best time to automate it. Get those free sale stocks into your portfolio, and once it's automated, close the app and enjoy those free capital gains once the market rises again. Now, fourth, do you have any unnecessary risks? You know, did you follow a hype one day with Dogecoin or whatever, and you just decided to step in, buy a bunch of it, and now think to yourself, maybe it's a bit too risky for my liking, maybe it's a little bit too volatile. Now is the time to look at it and maybe sell it or leave it if you think that it's justifying the risk. And now fifth is calmly look at your portfolio. And again, remind you, do this calmly with a clear mind. Set yourself up, go through your portfolio and compare it to the plan that you've set up. Once again, don't look at the news, look at your plan, where you are in your FIRE, how long you have left, is your FIRE number, is it good enough, does it need to be higher, does it need to be lower? Just go through it step by step and adjust accordingly. Okay, so now let's talk about the historical data. So we have 2022, Russia invades Ukraine, energy prices skyrocket and markets crash. Now recovery time, 18 months, and after that we even got some new highs. Then we have 2020, COVID happened and it was the fastest market crash ever. It dropped 34% in just 5 weeks. Recovery time, 5 months. And then we have 2008, which was an actual financial crisis. Now this one took 5 years to recover, but the data clearly shows that the people who stayed invested and dollar costing averaging through those 5 years, they came out with significantly more units and significantly more wealth than the people that waited for it to feel safe again. Again, history repeats itself. So don't let your emotions guide your decisions and just stick to your plan and just follow it. Now, let me tell you the things that I'm doing right now to stay ahead of this crisis. Now, here are the things that I'm doing personally. First up, I checked my buffer, and I have a financial buffer, meaning I'm safe that if anything happens, I do not need to sell my stocks. Second, I checked my allocations once, not every day, once. It's still in line with my plan, so I'm not changing it. Third, my dollar cost averaging is automated and I'm going to leave it that way, no change needed. Now, fourth, I have set myself a little bit of a rule. I'm not going to check my value of my portfolio every single day. I'm going to do it once a month. I compare it a little bit like being on a diet and trying to weigh yourself every hour. It's not going to move the needle and it's going to hurt to not see it move. Or even seeing it move upwards in the case of weighing yourself, and in my case seeing the stock market go down. So just checking once a month will suffice for right now. And then fifth, and to be honest, it's actually making this video. Because making this video, talking about it, thinking about it logically actually helps me to calm down as well and think about the things logically and stick with the plan. So let me know in the comments down below. Are you changing your plan? Are you staying the course? Or do something else? Let me know. Hey, to wrap it up, a crisis doesn't break your plan, it tests it. And if you're building a solid European fire portfolio, which is automated and long-term, this moment is nothing. It's just a simple speed bump in a very long road. And people who build real wealth during uncertainty don't do it by being smarter than everybody else. They do it by staying the course when everybody else doesn't. Now here, quick, the checklist once more. So first, check your buffer. 2, check your allocations. 3rd, your DCA, is it automated, yes or no? 4, unnecessary risks. And then 5th is your annual review. Now that was it. I hope it helped. If you have any questions, please leave a comment down below and I can reply to it. And hope to see you on the next video. Thanks for watching.